good evening, everyone, and welcome to tonight's webinar. Certainly happy that you're able to join on what is the final webinar that we are doing for 2023 in this series, which actually started in March 2020. Tonight, we're going to focus on a critical aspect of financial strategy, protecting your capital. And in today's economic landscape, which is characterized by volatility, uncertainty, geopolitical issues, wars, and ever-evolving market conditions, the need to protect your hard-earned capital has never been more pressing. And as we navigate through a year that's marked by all these tensions, the significance is just becoming more and more paramount. The challenges that were posed by the ongoing pandemic recovery, inflationary pressures, high interest rates, and just the fluctuating environment is part of the reason why I decided to focus on this. And the idea for the topic, it was based on conversations with clients. And even today, a client shared that concern when we were reviewing, and they were concerned about their exposure to bank stocks, which in the past has been a safe haven. But with interest rates squeezing folks with mortgages, that was a concern that they had. And also based on the failure of the SVB Bank in the US and Credit Suisse. And these concerns, I think, are valid. So tonight, we're going to touch on some ideas, but not all that have, they all have one thing in common. They all have an element of risk management baked into them and give it and a sense of predictability. And with interest rates much higher than in the past, it has shed new light on GICs as an option, along with annuities, which we're not going to touch on tonight, but something that I can speak to individuals separately about until at some point I'm able to do a webinar on that topic. So with that, let's take a look at the agenda for tonight. As it's customary, we're going to try to keep it tight. And we will be having a bit of a slider poll to sort of get a sense of individuals that are on the webinar and where their focus is. I'm going to also be doing a little bit tonight. I'm going to do the initial section on GICs just to bring people up to speed, and then I'll hand it over to Jennifer to focus on principal protected notes and structured notes. And then we'll open up for Q&A. So the goal is to try to start Q&A at around 7:45. The earliest, we're flexible. At the latest, we'll go, depend on time, might be if we start Q&A at 8. That's sort of the latest. So that's the plan for tonight. And then I typically stay on after the formal section for an Ask Me Anything session. For anyone joining for the first time, my name is Orlando Lopez. I am an investment advisor with RBC Domain Securities. It is now going on 4 years since I've been at RBC. A majority of that was spent during the COVID time, so it sort of feels like a blur sometimes. Prior to that, I've been in the industry for a number of years. I was at a different institution, and I've been passionate and continue to share all my knowledge with different platforms. So I've done, interviews on TV, BNN, radio, pretty active in sharing my knowledge on social media via these webinars and as well as a newsletter. So anything that's related to finance and sharing that knowledge and continuing to learn, that's usually where you'll typically find me. Other times you'll find me chasing behind 2 kids and trying to make sure everybody in my household is happy. I've got 2 little ones, 6 and 8, and married for over 10 years now. Now, we want to definitely give a warm welcome to our guest speaker, Jennifer Stewart, who brings 13 years of experience at RBC Capital Markets. And prior to that, she was at Merrill Lynch, Canada. And she's joining us tonight from the trading floor. So, Jennifer, thank you for staying behind. I really, really, really appreciate that.
Thank you for having me.
My pleasure. And so, as I mentioned, I will sort of share for you to, we'll do a quick poll just to kind of get a sense of the individuals that are joining. So you should be able to see You can use the QR code if you're using your mobile, if your mobile is close to you. If not, then you can go to slido.com and input that code 1328613. And let me just pull that screen up real quickly. Well, okay, so and then we'll start with the first question. The code is on the left as well. So question is, have you invested in either market-linked GICs or principal protected notes? Here. I apologize. This one is the first one, actually. Of the three options here, are you more inclined towards stable returns, even if they're lower, higher returns with some level of risk, or unsure? It sort of depends on the circumstances. And there's a code, it could ask you for a code. GICs is the code to input. So just on the bottom, you'll see the code, GICs. Give it a bit more, I think. So leaning more towards higher returns with some risk. Give it another moment, just for a few more. I think this time around we've got a passcode which is a bit newer this time. This is why I always like doing these polls, because it's always, I realize my assumptions are sometimes off. So, but I appreciate that. It is not what I had assumed, and definitely I think this will be helpful for Jennifer as well. So 67% indicate they would be more inclined towards higher returns with some level of risk. Doesn't necessarily mean excessive amount of risk, but with some risk. And then we've got 22% stable, even if it's lower. So the next question is, have you invested in either guaranteed income certificates, the traditional type, or market-linked GICs? So have you invested in guaranteed income certificates, GICs, or market-linked GICs? So yes to one or the other, or both, or neither of these vehicles. Okay. So predominantly, so 50% yes towards traditional GICs, and then followed by neither, and only 11% have done market-linked GICs as well as both. Okay. And final one, have you invested in either a market-linked GIC or principal protected note? So I think some of the previous response will spill over because not that many persons had indicated yes to market-linked GICs. So predominantly no so far, and curious to see if anyone has done a principal protected note. Okay, so there's definitely lots, lots of interest will be there on your section, Jennifer.
Okay, good to know.
Absolutely. So let me go back to slides. All right. So I need everyone to buckle up. What I'm going to be aiming to do is I'm going to try to take us sort of from 0 to maybe 30 kilometers per hour. And then Jennifer's then going to take us much further and faster, right? So definitely, hang tight, and I'll do my best to sort of bring you to that level, and then for Jennifer to sort of go deeper into principal protected notes. what I want to mention is that along with the pace and picking that up progressively, I wanted to sort of conceptualize that the engineering behind the product also will get a bit more sophisticated as we go from basic traditional GICs up towards principal protected notes. And you're going to discover that there can be customization specific to clients versus sort of mass-produced GICs. And the reason I share these images is to conceptualize that all four pictures show something that provides shelter in some way, shape, or form, starting with a basic canopy or tarp on the top left, then towards a tent for camping, followed by a cozy glamping tent, and then finally a more custom built wood cottage. So there are different levels and degrees to the forms of shelter. In the same way, there are going to be different degrees and forms in the vehicles that can be used to protect capital. So I just wanted to sort of use that to level set. So with GICs or guaranteed income certificates, they come with features that typically entail the ability to enter into an arrangement with the issuer, which is in many cases a financial institution such as a bank, over specific periods, 6 months, 1 year, 2, 3, 4, 5, up to 10 years. And what you're essentially doing is you are lending those funds, and there's an agreed return, or there's an agreed interest that's going to be paid to that individual. It could be paid periodically, or it could be paid at the date of maturity. In majority of cases, it's usually a fixed rate of return. The variable ones would sort of be what you might see with a market-linked one. And a lot of the things that people like about GICs is they're low risk in nature. There is an insurance, Canadian Deposit Insurance, which protects the individual in the event that the institution or the issuer were to go bankrupt. There's conditions to this in terms of the amount of insurance, but that's definitely something that individuals like, and it offers that capital preservation. There is no cost or transaction cost in investing or purchasing a GIC. It's sort of built into the rate that one will receive. So I usually like to sort of have people think about when they buy foreign currency. So when you buy US dollars, you don't pay for the transaction, but there is a bit of a spread, because if you were to walk back in immediately a minute later because you change your mind about the trip, the rate's going to be different. So you're lending your proceeds to the institution, which will then use that to lend out to mortgages at a different rate. So it's sort of built in that way. And some of the limitations or some of the downside is the liquidity. It's not as liquid as other investments that allow you to you can sell a stock, sell a unit in a mutual fund, and in about 3 days you've got cash available. There are some redeemable GICs, but some are not redeemable. So that flexibility or liquidity is not there. And in some cases, you might be able to get access to it, but there might be some sort of penalty. Now, a market-linked GIC is something that, there is innovation, right? And again, one of the things I really try to get across individuals is that within finance, just like technology, there is innovation in finance. So, as needs change, there's tweaks made. And if you think back to that image I'd shown with the different forms of shelter, what we had these traditional GICs, and you had, stock, for example. And there was nothing, market-linked GICs try to bring both the pros of GICs and the pros of investing in the stock market. And one of the things that people did not necessarily like about GICs is that you're limited on the upside, which you get from investing in the stock or in a business. So market-linked GICs allows for the potential for some upside over and above a traditional GIC. You do have the principal protected if it's held to maturity. And in some cases, worst case, you're just getting your principal back. You're not earning anything. So you haven't lost any, you haven't lost your principal. There's a negative return. There's just a zero return, depending on what it was linked to. Was the return return going to be based on the performance of the financial sector over that 5-year period when you initially made that arrangement as opposed to that 5 years later. Some of the downsides, it's even more illiquid, and you are really sort of banking on 2 specific dates. So again, not perfect, but something that was an evolution from traditional GICs. And the sort of, as we sort of move to the next level, again, in terms of what a principal protected note could offer. And what I want individuals to think about as Jennifer gets into it is that we're not necessarily saying either or, one or the other. These could be things that complement each other, right? So within a portfolio, there could be a space for traditional GICs to be there, and there could also be a space for alternatives. And I'll share one quick thing, and then I'll hand over to Jennifer, just to give folks a sense of what's out there these days. These are GICs that are present. They're in that 5% range right now. And we've got this is a list of about 20 different issuers, right? So typically when we're helping clients, we're looking at, even within the account that we've got at RBC, we can use a GIC from a different institution. So I'll hand it over to Jennifer just to really kind of walk us through principal protected notes and sort of how this could be a complement or portion of that strategy towards protecting capital, if that's a goal, or, and I think that first poll actually was eye-opening, that some individuals on this call right now would want a higher rate of return with some risk. So we're not going to make the assumption that everyone is sort of just, not wanting to get, extra return.
Okay, well, thanks, Orlando. That was a great intro on GICs. I appreciate that. It's great to be here and talk to everybody about RBC structured notes and specifically RBC principal protected notes. I will say, being on the desk for almost 14 years now, that sales on our desk have been growing stronger, especially in the past year and a half. I think that investment advisors across the country, they can no longer ignore structured notes. And I believe that the end clients, like everybody on this WebEx call, is starting to demand seeing structured notes as part of the products that they're getting from their investment advisors. We now also have a lot of third-party investment advisors buying our notes from firms like CIBC, TD, BMO, Scotia. So the end clients are fully getting exposure to structured notes now, which is really great. In addition to that, I think we have a lot of repeat buyers. So we have a lot of people that already own notes in their accounts, and they see how they're doing. They see that they are working out and they're actually paying off as per the payoff profile diagram that we have in our marketing material. I'll walk everyone through some examples in a moment. And I would say about a year and a half ago, when interest rates were lower, PPNs offered great value for clients who were searching for yield. But nowadays, with the higher interest rates, I think that still holds true. The terms of RBC notes have improved along with the rise in rates, and they still offer clients chances for above market yields, along with having the full principal protection. So I'm going to share the screen. Orlando, is that?
Yep.
Okay. All right, I'll do that in a second here. Okay. Okay, so do you see that now? Or share here?
There we go.
Okay, great. So just for everybody's interest as well, you can see all of our notes on rbcnotes.com. Anyone can check out that website if you want to bookmark it, and we have our current offerings page so you can see at a glance everything we have to offer at any time. So please refer to that as we're talking or as we go along. And I am just going to jump through some of the slides here. So I'm going to go to slide 2. So what is a structured note? So an RBC structured note is a senior unsecured debt obligation of RBC. So that means we rank equally, our notes rank equally with bank depositors at Royal Bank. So that's a really great thing. So in the event of a liquidation of any firm, and as a note holder, you would rank equally with a bank depositor. As Orlando mentioned, GICs have CDIC insurance. Principal protected notes do not. And I think that the CDIC insurance is only good up to $100,000. So I always like to say, my favorite saying is, why buy more house insurance than you need? So I feel that the principal protection and the guarantee from RBC at maturity is sufficient. And some of you may agree and some of you may not agree, but that's a conversation that you can definitely have with Orlando to decide what exactly your risk tolerance is. But as we just discussed, some people are willing to take on a little bit more risk in search of higher returns. So that's where principal protected notes could fit in quite nicely. So I would then mention the credit quality of RBC. So RBC is rated AA low by Standard & Poor's. And that is the highest credit on the street in Canada and the highest credit on the street in the US as well. I used to sell structured notes to the RBC US Wealth Management channel, and credit quality is a huge issue for them. The credit crisis in 2008, 2009 is still fresh in their minds. If you had owned a Lehman Brothers note, you would have been out of luck. So they still remember those firms going down, and I'm sure many of them did own some Lehman Brothers notes. So at the end of the day, you have to be comfortable with the credit that you're owning. In most cases, I would suggest diversifying, but absolutely, if you own RBC, I think that's great credit quality, and it's just good, comfort for you to sleep at night knowing that it's the highest credit quality among the Canadian banks in Canada and also in the US as well. So the other thing I would point out is the next bullet point there, the payoff at maturity and the coupon, if it has a coupon, is linked to the performance of an underlying equity or asset class. So we often do notes linked to stock baskets. We can do them linked to single stocks, to indices. So it's a great way for clients to get exposure to international underlyings, global underlyings. Some of the most popular underlyings we have right now are sector specific, like the banks, the insurance companies, the pipelines, the utilities, blue chip baskets that are similar to the TSX. We also do notes on the TSX 60, on the S&P 500 is another popular one. And we can also hedge your currency into Canadian dollars or keep it in US dollars if you want it on the S&P 500. So those are some real benefits. We even do indices, global and international indices like the MSCI World Index or the Nikkei, the Euro Stocks Index, the NASDAQ, the list goes on. So we have a lot of underlyings that clients can gain exposure to that they might not otherwise be able to get exposure to through stock picking. So just there in terms of principal protected notes on the right-hand side, they're similar to GICs, but they're more customizable. So that's the other point I'd like to bring up is about 65% of our sales right now are for our custom structured notes business. So we create bespoke notes for clients, for ultra high net worth clients, and you need about $1 million and we can create your own note. So we can customize your underlying, your term to maturity, your level of protection on the downside, and your payoff profile on the upside. So that's really something to keep in mind. If you don't see what you like on our website on the rbcnotes.com, we can absolutely create something specifically for you.
So then on the website, just to clarify that part, to get that more customized one, that watermark is $1 million. But what is on the website, those what's the starting point for those if a client wanted to?
$5,000 minimum ticket.
Okay, so 5,000 minimum, and then at least it allows for. I'm sure anyone that's never done it would want to then maybe gradually get exposure and then from there decide if it makes sense to continue. So
I think that's a great idea. Yeah, get to learn the space, get comfortable with it, and then you can look into doing your own custom note. Okay, so we'll keep going here. I'm going to jump to the next slide. So we're going to talk specifically about principal protected notes now, and we're going to have 3 examples that I wanted to refer to. So the first one is on the TSX 60 index, and I would say this is a pretty plain vanilla capital appreciation note or a growth note on the TSX. So it's you can buy it through A class or F class. A class is it pays the advisor commission, and you are not charged an annual fee. The F class is you put it in a fee-based account, and these are of course discussions that you can have with Orlando once you figure out what type of account you want to set up and which is the most cost-effective for you. So for now, I think I'll just refer to the F class to make things simpler. So on the right-hand side here, I always love looking at the pictures. Pictures speak volumes. So this dotted line
Can you
here,
zoom in a little bit, Jennifer, just so that they can see the picture? Yeah, just a little bit.
sure, no problem. Okay, second.
Yeah, yeah, wonderful.
Okay, so on the dotted line there, that is the 45-degree line or the payoff 45-degree line of the TSX 60 index. We're offering you the yellow line. So at maturity, if the TSX has gone down, you're just getting the yellow line. You're getting 100% of your money back, and your return would be zero. But during a period when the TSX 60 was down, you're getting your $100 par value back at maturity, guaranteed by RBC. On the upside, if the TSX has any returns at all, you're getting 100% participation. Okay, so 1 for 1 on the upside. So I think this is a great way to gain exposure to the TSX 60 compared to say, for example, an XIU, the TSX ETF. So with the ETF, you don't get full principal protection on the downside. And indices do trend higher over time, but what if you buy it in the wrong time frame? What if you buy it at the top and then it corrects and you sell it and you have a loss? So this is a great way to preserve capital and yet still gain equity exposure. So if you want equity exposure, you're exposing yourself to risk. But this way, you've eliminated the risk of the downside. The only negative on these is you do not receive the dividends on the underlying index, but that would be the same for any equity-linked GIC as well. So
Jennifer, can I ask a quick
yes,
question? And
sure.
I'm really thinking out loud, and this is just because of the conversation I've been having. This could be something that somebody could, one, use to get exposure to the market. But I'm thinking, because I'm having a lot of de-risking conversations, could this also be ideal for somebody who already has exposure to the equity market, but we're now trying to go down the risk ladder? They can use this to still have exposure towards the equity space, but with more protection, because then maybe rather than fully exit and go towards, let's say, maybe a regular GIC, if we go towards a vehicle like this, you still get exposure to the upside, but we're sort of locking in some gains. Do you see this with some clients where they're moving in that direction as opposed to from, I don't know, cash, and then they're using this to get exposure?
Yes, absolutely. That works as well. That's a great reason
Mm-hmm.
to, yeah, it could lower the risk profile of your overall
Mm-hmm.
portfolio. Yes.
Okay, great.
And so the one other thing I would point out is the term on this is 2.75 years, and you're getting 100% participation. But if you were willing to go longer in term, like let's say 4 years, then we could get your participation from 100% to, I'm just estimating here, but to about 130%. So whatever the TSX, whatever returns the TSX has, you're getting 1.3 times the upside. So if you're comfortable with going 4 years in term, I think that's a great note to have. And everybody likes getting exposure to the TSX 60. It's diversified and it's a good proxy for the Canadian market. So, okay, I like this note. I'm just going to make it a little smaller again, and we're going to go to the second note. So now we're going to choose a sector specific. We're going to look at the Canadian banks, which are really popular right now for notes that I've been doing, for notes that we've been striking for clients. Everybody seems to like the fact that the Canadian banks are still off of their February 2022 highs. They're off approximately 24%, 20 to 24%. And so a lot of people feel that, that will come back, these banks will come back and eventually, and so it's a nice time to get them on sale, basically, on sale by 24%. So this note here is very similar to it's the same structure as the previous note. It's based on the selective Canadian banks, which is the 6 Canadian banks equal weight. And we've got it at a nice short 2.5-year term. A lot of clients seem to like the shorter terms these days, but we don't have to do it 2.5 years. If you want this to be your core Canadian equity position, then we can absolutely go longer in term, 3, 4, 5 years, whichever you prefer. So we've chosen 2.5 years for this example. So once again, this is the same payoff profile here. So on the downside, that's the 45-degree line of the banks. You're getting the yellow line on the downside, and you're getting 100% participation for the A class. And for the F class, you are getting 1.3 times the upside of the Canadian bank. So whatever the banks do, you multiply that return by 1.3 in a nice short 2.5-year term. So if you think the banks are attractively priced right now, and that they're going to come back in value, might as well get 1.3 times this upside you think is going to happen instead of 1 for 1 on the upside, and get your full principal protection on the downside. So we're addressing your capital preservation, and we're giving you enhanced participation on the upside as well. The only, as I
Worst
said,
case, you're just getting your money back.
that's right.
That's the worst case
So it'd be the
over that
opportunity
2
cost
years.
of not being invested, but during a time when the underlying you wanted to be invested in was down. So I think you'd much rather just get your money back. So these are growth notes that I talked about. Now I want to talk about a income note. So this I'd say would be a good alternative to talk about when we think of GICs, or when we would typically have invested in GICs. So this is an auto-callable principal protected note. So this is on the selective blue chip index, and I am just going to quickly show you what's in this basket. So this is a basket of 10 stocks that are highly correlated to the TSX. So it's Pembina, TD, Enbridge, Great West, BCE, Manulife, TC Energy, TELUS, BNS, and CIBC. And that basket does not change. It's a fixed basket. It's actually an index. So this is a 7-year term to maturity, but it's unlikely that this will go for 7 years, and I'll explain that because it is auto-callable after every year. There's a chance it would get called away. So starting at the end of year 1, if that index is higher by 5% at the end of year 1, then this will automatically be called at $100 par value plus your coupon. So your F-class coupon there would be 10.5%, which is pretty amazing. That's, more than 2 times what a GIC, a 5-year GIC is paying. And when I looked at your GIC
Can we use some? Maybe can we
slide
use?
there.
Let's assume our client puts out 100,000
Okay.
today. So we're November 22nd, and we've used this. We've gone into this auto-callable PPN 100,000.
Yes.
So next year, we're having a webinar again, and now the 10 stocks as an aggregate, depending on how they've performed, not just an individual but on a whole. It could be, they could all be down, or they could all be up. So let's kind of walk through what then happens to the 100,000, and yeah,
Okay.
maybe you can zoom into the chart, to the diagram. That might help.
Okay, sure. So, so as I mentioned, the way you get the upside on this note is through receiving the annual coupon. And the only way you get the coupon is if and when you are auto-called on one of the 7 annual observation dates. So you have 7 chances to get a coupon of 10.5% per annum. So if you're auto-called in year 1, you get called at $110.50, or you get called at $100 par value plus a 10.5% coupon. If you're auto-called in year 2, you get called at $100 par value plus a 21% coupon. If you're auto-called in year 3, you get called at $100 plus a 31.5% coupon. So it remembers the previous years, and you get
And get a
you
bit
get your
more.
10.5 that year. So year 4, you would get called at $100 plus a 42% coupon. If it lasted to year 5, you'd get called at $100 plus a 52.5% coupon. And if it lasted till year 6, you'd get auto called at $100 plus a 63% coupon. And finally, if it went to year 7, you would get called at $100 par value plus 73.5% coupon. So the way it's called
Yeah.
is if the underlying index, that blue chip index, is higher by 5% from the day 1 strike level. Let's say we struck and closed the note today. It's higher by 5%. at the end of 1 year on that exact annual observation date at the 4 p.m. close, then it's automatically called. It's rules-based.
Mm,
There's no
okay.
discretion. It's simply
No
math.
discussion.
If it's higher by 5%, then this is
Then
getting called at $100 and 10.5% coupon. If it's not higher by 5%, that's okay. This note continues on, and you're now looking
into
to
the next
be
year.
called at the end of year 2, and it remembered the year 1 coupon, so you're hoping to be called at $100 plus a 21% coupon. If it's not called then,
Yeah.
that's
So
okay. This note continues on, and you're eligible to be called at the end of year 3. So you get the idea, but it just has to be higher by
by
5%
5%.
from the day 1 strike level.
Okay. So let me then, for everyone on the call, let's say we've got a twin. One of them purchases this note with 100,000. The other twin had 100,000 and decided to purchase the stocks in these 10 companies, 10,000 each in these stocks. A year from now, the one that invested in the market bought these stocks, looks at his portfolio, and if that portfolio shows that exactly 1 year from now, the market value for all his 10 stocks is 106,000 because it went up 6% in aggregate. That would result in the other twin being called. So he's getting a call and saying, here you go. Here's 105,000 plus, because it hit that rule. The value for those underlying securities is above that 5% mark. Here's your $105. There's no, and shake hands, off you go, figure out what you're going to do with 105,000. But you got an extra 5,000. If the value for those, let's say it's an alternative scenario, it's only at 103,000. So it was not a very good year. The twin that invested in the market with those exact companies is that only went up 3%. There's no auto call. It rolls over into another year, to year 2, which could then be a potential higher amount.
21% return.
21%. Here is 121,000 after 2 years. If the underlying securities went up by, in year 2, it's more than 5% at that point, right?
No, so
What's the
it's
watermark?
always just it's just the day 1 strike level. It just has to be higher by 5% from the day 1 strike
Okay.
level. So you're
Got
buying
you.
this note thinking that I think that stock basket is going to be higher by 5% at some point along the next 7 years. So that's the bet you're making. And I
Got you.
think that's a very decent bet, in my opinion.
And you'll
So
get that.
will get called in one of those 7 years at a
Mhm.
very handsome return, quite frankly, at a
Starting at
10.5%
10.
per annum
Yeah. 10
return.
or more, pretty much. Yeah. Gotcha.
Yeah. So, and any returns that it is above that amount, you participate 5%. So it's just a little bit of a sweetener. Like let's say that basket had a really good year and it went up 20%. Well, you would get called at 110.50 plus 5% returns for any returns in excess of 10.5 up to the 20.
Yeah.
So a little sweetener to participate in the upside. But I think that you just have to say what for that situation for the 2 twins buying. So the one twin, when it went up by 5%, his stock basket would be up 5%. In this note, he would have gotten 10.5%. So you just need to be moderately bullish. You just want this basket to be higher by 5%. Whereas if you're long the stocks, you want to be really bullish. You want it to shoot the lights out and make 10.5%, but that's going to be tough to replicate. So with this note, you just need it to be higher by 5% in one of those 7 years, and you'll get paid very handsomely for it.
Yeah.
More than double what a GIC is paying, and
Yeah.
full principal protection. And the other point, I should have mentioned compared to a GIC is we have daily liquidity. So GICs are not liquid, as you mentioned. We have daily liquidity for all of our notes. So if someone needs to sell for whatever reason, they can absolutely sell.
Okay.
And it would be at the market value, not, I can't guarantee to be 100. It could be at a premium to par, could be at a discount to par.
Okay. Great.
Okay, so moving along here. So those are our principal protected notes. And now I just want to talk about another structure of note that's been selling very well on our desk. We've sold, I think, almost $1 billion in the last calendar year. And this is actually a bond. It's called a fixed rate callable bond. And this is not the same as a principal protected note issued by RBC, which is AA rated. These are senior bonds issued by RBC, and they're rated single A by Standard & Poor's. And they don't rank equally with bank depositors. So they're senior bonds rated A, and in the event of a liquidation, they could be bailed into equity. Okay, so that's an important point to note. I don't think you can, you know, it's not a direct apples to apples comparison with a PPN, but it's still, a lot of people feel very comfortable with buying a senior bond from RBC that's rated A by Standard & Poor's. And they offer coupons, so that are, I would say, and I'm just gonna, you know, estimate it here, but, or just average it, but about 1% over what 5-year GICs are paying. So, and I'll go into, actually, I'm going to go into the rates right now just to show you. So, so this is a 10-year bond, but it's callable after 1 year. You're looking at a
A little bit more zoom in.
6.1% coupon. Yeah, I can zoom in, no
Yes,
problem.
awesome.
Okay, so, and then a 10-year bond callable after 2 years. I'll go into this a little bit more. I just want to show you the rates quickly. Is
Mm-hmm.
about 6.05%. A 10-year
Yes.
bond not callable for 5 years is about 5.9% right now. And so that's for, and then the commission ones are a little bit lower. But I just want to show you the rates. So 5-year GIC is about 5%. You're looking anywhere from, like, you know, 80 to or 65 to 110 beeps over. Okay, so just to give you an idea, so you're being compensated for the extra risk you're taking. Okay, as
Yes.
you discussed before, if someone's willing to take on a little bit more risk, this is what you can look at. And so these are fixed rate callables. So the most sort of, remember how we talked about the last principal protected note that was callable, and I said that's rules based, there's no
Mm-hmm.
discretion. There is discretion on whether we call these. These are issuer call. So it's at RBC's discretion as the issuer. But I'd say the most important factor in whether these are called or not would be the overall level of interest rates. So to some degree, funding levels and interest rate volatility, but to a lesser extent. So if, for example, interest rates go down from current levels after you've locked in your note, then RBC would likely call it at either the 1-year mark, the 2-year mark, or the 5-year mark, whichever it is, whichever note you choose. If rates go higher, then they would likely not call it because it's more expensive for them. So if it's not called, then you could be, you know, owning this for longer than you planned. And you'd be at a rate, for example, 6.1%, whereas rates have gone higher from that. So you'd be sort of in a slightly lower yielding bond that's longer term than you might have thought. So something to keep in mind, as rates rally, the price of the bond could come down a little bit, mark to market, but at maturity, this would be redeemed at par, and you would have made 6.1% for every year that you owned it. So when it says no call for 1 year, that means it's eligible to be called at the end of 1 year, and every year thereafter, there's another eligible call date. So you've got, you know, 9 chances to be called again.
Mm-hmm.
And if it is called, you could actually be called at 1 year. So this would be a 1-year term that you made 6.1%, and then you would face what we call call or reinvestment risk, where in a falling rate environment, the note is most likely to be called. So you would only see that, you know, 1 or 2 year or 5 years worth of coupons, and you would have to reinvest the proceeds at the current lower market rates. So, you know, that's something that, Orlando, you can absolutely discuss with your clients, you know, about reinvestment rate risk. And if they're willing to, you know, that's just the way it goes. That's, you know, everything seems to have a term to maturity here. So at some point you would face reinvestment rate risk anyways. But if you are worried about that, then I would choose the 10-year no call 5, where you get at least 5 years worth of coupons at 5.9%. So 90 beeps over what 5-year GICs are paying right now.
Yeah, yeah. The
So
best rate on a 5 year is 5.06 from one of the smaller issuers. So yeah, it's right at 5 basically.
So there you go. So you can compare these to GICs. GICs would be higher in credit quality, and there's no bail-in feature. but they're less liquid. These are liquid. We have daily liquidity on these, and we offer, you know, a yield pickup anywhere from 65 to 110 beeps over. And I think they represent great alternatives and fit into the space of what we're trying to show clients here, other alternatives to GICs.
Yeah.
So I think that's it for my slides for now there, Orlando.
Okay. And perfect time to kind of shift into questions. It is right on the money. Right on the maturity date, 7:40. So Q&A maturity has arrived, and there is a raise hand feature that will allow you to sort of, and I can unmute you. I'm just going to show a quick image of what that. So some folks they are on mobile device. You may have to sort of touch your screen for it to show you the different menu options. But I'm just going to show a real screen right here, what that will look like. But that was really, really very clear and helpful. Okay, so this is what the raise hand feature looks like. Okay, there we go. So it's a tiny bit of a, just a little palm. And if you use that, then I will be able to unmute you because everybody is on mute by default. Let me just, and it could be related to structured notes. It could be related to GICs, or just even, you know, thoughts on, was this from your understanding or perception of principal protected notes? Is this something that is totally different from what you had sort of heard before, or you know, sort of similar to maybe what your understanding of principal protected notes were, right? And again, like I mentioned at the beginning, I see these as options, and I always say that whenever I sort of share this sort of information, it's not to indicate to someone, you know, that you should do this. It's just important for you to know that you can, right? And then from there, you're able to decide. I just saw Thor, your hand came up. Let me just unmute you. It went up and then down, but so just in case. Okay, Thor, I just unmuted you. Okay, and Carrie Ann, I'm going to unmute you. Welcome. Is there one on the site? And I'm actually going to pull up rbcnotes.com. Or do you want to? I'll let you. Maybe I'll let you share your screen to show where people can find the info on it themselves, regardless of if there's a calculator. So I'm going to give you the control again, Jennifer, real quick.
Sure. So there's not a calculator per se.
Well, this is what I've got. So, and this is the correct website, right? Structured notes, rbcnotes.com.
Yes.
Yeah.
So you go on to current offerings. And then it brings up the principal protected notes first.
Mm-hmm.
And then if you scroll down, it's the non-principal protected notes. But there's lots, and on any given day, you know, this list can change because we have a finite selling window. Most of our notes are open for 2-week selling periods, sometimes shorter. So, you know, there's times we're replenishing the site, and sometimes they close and we have to get the new ones up. So this list is always changing.
And this is the selective one here. One of them. Oh, there we go.
That's the blue chip one, yeah, that we were talking about.
And
Yes,
and there's a bank one.
that's right. The bank,
Yeah.
the 2.5-year bank one. Yeah.
Yeah. Okay. Wonderful.
So I guess in answer to your question, Carrie Ann, we don't really have a calculator, but we can always figure that out for you, like more specifically, you know, if you had some mathematical questions on what would make more sense to invest in.
You're welcome, and thanks for joining. And it's 7:51, so a bit more time if there's any other questions. Just take a quick look again, and we've got another question.
So yeah, so I would say that's probably why the banks are trading down 24% from their 52-week highs. Everybody's feeling that in the next 2 years, when everybody's mortgage does come up for renewal, a lot of people will be struggling with that. There's no question, but I think the fact that they're off 24%, that's already priced into the stocks. And I don't feel like it's going to be like, you know, the credit crisis 08, 09, when people had those adjustable rate mortgages in the US and they were really defaulting, like they faced some extreme default rates on their mortgages, and financial institutions, couldn't cope, and some failed. I don't think that's going to be the case in Canada. I think that actually David Rosenberg just put out an interesting article saying that the Bank of Canada will have to lower rates to accommodate that, now that the inflation numbers seem to be coming in relatively benign, under control. Hopefully the Bank of Canada will lower rates a little bit in the next couple of years to make it a little bit easier for people. But I can't really comment so much so on whether people will be defaulting. I don't know. I can't predict that. But I feel like the banks have things under control, and they're typically banks do well in rising interest rate environments. They make more money on their bank deposits, and so I would say, yeah. Orlando, did you have any comments on that, or?
I think what it sort of that's the concern that I mentioned that you're not, it's not uncommon. Where I think it might sort of then lead one to look at is, should I be, or do I want to be exposed to a bank stock outright right now as the sector, or exposed to it but with some protection, because I'm more sort of leaning, if you're leaning more sort of on a pessimistic view, well, if one of these vehicles can at least protect your principal, right? But if you're wrong and things actually do turn out well and the sector does perform well, well, you're exposed to the upside. So it might be a stronger case toward the whole conversation of protecting that capital. And again, it might mean that you're not earning as much if there is a run up. So that's sort of how I would look at it, right? I always approach things from a hope for the best, but plan for the worst. So I think we don't know what the future, we don't have crystal balls, but if we try to start doing things in the sense that we don't regret the outcome, because we've already sort of planned for that worst case scenario. And that worst case scenario kind of would be sort of what you're leaning towards. If the banks get impacted negatively, their stock prices not only stay where they are, but probably even go down. Well, anybody that's invested or exposed to it would feel that. But these sort of vehicles that are giving you some cushion, where worst case you just have your capital back. If those
And
are ones.
that sounds great, Orlando. And I would just add in that, sorry, banks make money in rising rate environments. They don't make money on their bank deposits. They make money on their mortgages and their loans that are higher rates. Also, if you're worried about the banks, then don't choose that underlying. You have to feel comfortable with your investments. And
Mm-hmm.
if you're worried about that sector, then just avoid it. Buy another sector, or the TSX 60. We've got lots of other popular underlyings like the utilities, the pipelines, the insurance companies, U.S. financials, the S&P 500, the TSX 60. So if you're worried, then you can always avoid that
Yeah.
sector. Well, I would say the trend in the last 2 weeks is rates have really come down. So the CPI, Consumer Price Index number, came in and it was weaker than expected. So that was really good for the equity markets. And a lot of people feel that the rate hikes were at or near the end of the rate hikes for sure. So I would say, yes, rates are higher in general, but I think they're sort of at their peaking. And in terms of how that would affect the tech sector, I don't know, Orlando, do you want to jump in there? That's not my area of expertise, but.
Yeah, and the tech sector, I mean, one year it struggles horribly, and then the next year, I was actually sharing an update with clients, and year to date, that's been one of the stronger sectors. So I always go back to the principle of proper diversification, not only across sectors, across asset classes, right? I mean, even in Canada, we do see sometimes clients are very overexposed to real estate as being a big part of their network, right? And trying to say, okay, you know, don't be overexposed to just one vehicle. So you've got hard assets, you've got financial assets, you've got insurance-based assets, because as the pandemic really reminded us, there are sort of outliers that can occur. So, you know, being overweight towards one piece and letting the emotions take over, which sometimes is greed, like you sort of lean into that one thing because it's doing well. That can sometimes spell disaster. So that's really why I'm always trying to focus. And I guess you could kind of we can use the term that Jennifer mentioned, sort of rules-based, right? Rules-based investing. And part of that is what we try to build into even when we're investing in companies. Some of those things that I really like is when we've got a rule around when do we exit a position. So we enter expecting that once it hits that watermark, we're going to reduce the exposure by, let's say, 30%. And that allows for, regardless of if we think it's going to continue to rise, we're executing because that was the initial plan going forward. And that helps to takes out some of the you know, the pitfalls that individuals can get caught up into around, you know, preferring one sector over another or one vehicle versus another. I hope that helps. But really good, two good questions, Wendy.
Yeah,
Thank you very much. Appreciate it. And I'm just looking at the time. So it's 7:59, and I want to share one final thing, because as I mentioned, this is the last webinar for 2023. So for 2024, one of the plans is, which is, it's sort of become an annual, it will be the third year that I'll be doing a webinar focused on the concept of retirement elsewhere. 2021, what was the first year I did that? Yeah, 2021, I did retirement elsewhere. We focused on Belize and Costa Rica. And that was eye-opening for a lot of folks. We sort of said, okay, could we do something focused on the U.S.? So we did the U.S. Sunbelt, which includes Florida and other places. And the idea or the plan is to look at Portugal. So what we do in these sort of conversations is we're sort of not looking at the technical and the numbers or the Excel. We're looking at the conversation about retirement. What sort of lifestyle is the individual trying to create, right? A lot of individuals will say they want the ability or the option to be somewhere tropical, whether on a full-time or a part-time basis. So we get individuals that are from these locations that can share certain bits of information, whether it might be real estate related or it might be around retirement visas, right? So, you know, like Belize has a retirement visa, for example. What are the requirements for these things, right? You know, can you purchase real estate or not? So that's something I just want to put on people's radar. It will be in February. That will probably do that probably the third week, not the last week. The last week of February is usually a busy time of the year. But definitely just stay tuned, and we'll get more details on that. And the other thing would be call to action. I'm always open to a discussion, a second opinion. An opinion from myself or individuals that I collaborate with, right? Because everyone's situation is different, and it depends on what you're trying to achieve. And my approach is, one, to work with individuals from across the industry. So usually if I don't know, I'm trying to make sure that I know somebody who does, and that's kind of how we get towards solutions. And continue to attend these webinars. You know, it's a way to sort of, one, get that information that you can make more informed decisions. I don't think the idea of trying to gain financial literacy is a one-off thing. We're always remain curious. That's sort of something that I try to do. So I'm trying to continue to learn and just share that information with clients and members of the community. And that is, these are the three pillars: education, empowerment, and execution. So if we help you to get that information, then we can sort of gradually sort of work through what can you do to execute some of these things. And maybe the execution is not now, maybe it's in the future, but at least you know some of the options that exist. And if you are sort of keen to sort of want, have an analysis done, that's something that I can do to sort of highlight or point out certain gaps that might exist. So with that, I want to thank everyone for joining on your Wednesday evening. Jennifer, thank you for staying behind. I really
Thank you for having me,
appreciate it.
Orlando. I appreciate it.
Yeah, it was good. I enjoyed it. Lots of good information, and I think individuals, for sure, it doesn't end here. Go do some research. The website you can go to. There is information out there, but what we're trying to do is at least to bring that concept that now you know what to search for. So go kind of take a deeper look in towards principal protected notes from the RBC website, other websites. And that allows you to sort of know some of the options that you can use to reduce risk, manage risk, and protect capital. So thank you, Jen, and we'll be in touch.
Okay, thank you.